Silver just did something it has not done in weeks. It put together a winning streak, several green days in a row, one after another, after a stretch of pain that had a lot of people quietly giving up on it. Silver had been knocked down hard into the mid 50s, an ugly, fast shakeout, its lowest in the better part of a year. And then, without much warning, it turned. It clawed its way back above 60, and it kept going, day after day, leading gold on the way up. If you own silver right now, your first honest reaction to that is probably relief. Finally, about time. And I understand it. But I need you to hold that feeling for just a second, because the streak itself is not the story. The streak is what you can see. The story is why it happened, and what those green days are quietly telling you underneath, in a language Wall Street speaks fluently and is counting on you never to learn. So here is my promise to you. By the end of this, you are going to understand what a run of green days after a brutal shakeout actually means. Not the cheerleading version you get everywhere else, the real one. And you are going to see the one signal hiding inside this streak that almost nobody on the financial channels will name out loud, because naming it would give away the whole game they are playing. That one signal I am saving for the last few minutes of this, on purpose, because it is the thing that changes how you read every dip and every bounce for the rest of your life as an owner of this metal. And it is the exact part they leave on the cutting room floor. Stay with me all the way to the end, and it is yours. Because here is the first thing you have to understand, and it is the thing that reframes everything. This streak did not come out of nowhere. It came out of a reflex, a rescue reflex that was born in this country on one single terrifying day, almost 40 years ago, in the span of about 12 hours. And once you have seen where that reflex came from and who it quietly rewards, you are never going to look at a green streak the same way again. So let me take you back there. Not to a chart, to a trading floor. Picture a man on the floor of a brokerage, an ordinary man in his 40s, a fellow who had been around markets long enough to believe he had already seen everything they could do. It is a Monday morning in the autumn of 1987. He is standing at his desk with a phone on each shoulder, and he is watching the numbers on his screen do something he did not think was possible. The market is not falling. It is collapsing. Not a few percent. Not a bad day. By the time the closing bell rings that afternoon, the market has lost nearly a quarter of its entire value in one single session. The worst one-day crash in the history of the United States. Worse in percentage terms than any single day of the Great Depression itself. He does not say much. Nobody on that floor is saying much. There is a particular kind of silence that falls over a room when everyone in it is doing the same terrible arithmetic at the same time. He goes home that night, and he does not sleep, because the thought running through his head is the one running through every head in that building. This is 1929 again. Tomorrow the whole thing comes apart, and everything I built goes with it. And here is where the story turns. Here is where the reflex is born, and I want you to watch it happen, because you are living inside the consequences of it right now. There was a new man running the Federal Reserve. He had been in the chair about 2 months. 2 months. Barely long enough to find his own office, to learn where the coffee was. And the next morning, before the market opened, before the panic could pick up where it left off, that brand new chairman put out a single sentence. Not a speech, not a plan, one sentence. That the Federal Reserve stood ready to serve as a source of liquidity to support the economic and financial system. That was the whole thing. One sentence. But everyone who heard it understood precisely what it meant, because underneath the careful language, it said one blunt thing. We will not let it fall. Whatever it takes, we will flood this system with freshly made money before we let it come apart. And the market, which had been standing at the edge of the abyss, stopped. It steadied. And then, slowly, it began to climb back out. The man on that floor never forgot that morning as long as he lived. Not because of the crash. Crashes he could understand. He never forgot it because of what he watched be born the next day. He had just watched the market learn in real time that there is a floor underneath it. That when things break badly enough, the rescue comes. Not maybe, not sometimes, reliably. He had watched the birth of the thing traders would spend the next 40 years calling, half as a joke and half in dead earnest, the Fed put, an invisible insurance policy that nobody pays a dime for and that everybody, deep down, has learned to count on. And once that reflex exists, once the market knows in its bones that the printing press is standing behind it, something changes forever in how every asset gets priced. Because now, the smart money is no longer just asking what a thing is worth. It is asking a second question, quietly, under its breath. What happens to this when they flood the system again? And the answer to that question is the whole reason you are watching silver put together a streak of green days right now. Let me connect it for you, because this is the part they skip. Silver and gold are the assets that do best precisely when the world expects money to be created out of thin air. That is their entire job. They are the things that cannot be printed in a world run by people who can print everything else. So when the market smells a rescue coming, when it senses that the pressure is about to ease and the liquidity is about to flow, hard assets are the first thing the smart money reaches for. It front runs the flood. It buys the lifeboat before the ship starts taking on water, not after. And that is exactly why the decisions you make in an environment like this one matter more than the decisions you make in a calm one. Let me say something directly to you here, because this is the moment it counts. If you are a person with $100,000 or more sitting in a retirement account, a 401k, an IRA, something you spent a working lifetime slowly filling, then you are exactly the person this reflex was built to take advantage of, one way or the other. Either you understand how the rescue machine works and you position calmly ahead of it, or you are the one it quietly transfers wealth away from, while you are told the bounce was random. That is the whole reason I put together a free retirement protection guide. It walks through in plain English how a number of retirees are moving a portion of their savings into physical gold and silver without triggering taxes or penalties, held inside the tax-advantaged account they already have, metal they actually own instead of a paper promise on a screen. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. And if you go through it and you want to talk it over with a human being, there is a free, no-obligation, one-on-one educational session for folks with $100,000 or more in any retirement account. No pressure, nothing to buy, just answers. All right, now let me show you why this particular streak fits that reflex so perfectly. Go back to what actually happened to silver over the last stretch. In plain terms, it got hammered down into the mid-50s. And the reason it got hammered was not the deficit, and not China, and not some flaw in the metal. It got hammered because of the Federal Reserve. The Fed is now run by Kevin Warsh, and Warsh is a hawk. He talks about inflation still being too high. He has put the possibility of a rate hike back on the table, when the last regime had everyone expecting cuts. And silver, which pays you no interest to hold it, always takes the hardest punch when the market thinks rates are heading up, because now the cash in the bank looks more attractive by comparison. So when that fear peaked, silver got flushed. That was the Fed temporarily overpowering everything else. And then the fear eased, just a little, just a notch. Rate hike bets softened slightly. The pressure came off, and watch what happened. Silver did not drift back up gently. It snapped. It came roaring back above 60 and strung together those green days, leading gold the entire way. Gold, meanwhile, barely flinched through the whole episode. It corrected only modestly and then rallied back over 4,100, quietly, to a multi-week high, without any of silver's drama. And that gap, gold's small, calm round trip against silver's violent one, left the gold to silver ratio, which is just how many ounces of silver it takes to buy 1 ounce of gold, easing back down into the high 60s as silver outran gold. Now do you see it? The streak is the reflex re-engaging. The instant the boot lifted even slightly off the market's throat, the smart money went straight back to front-running the floods, and it reached first for the most beaten down, most rate-sensitive hard asset on the board, which is silver. The green days are not silver telling you the coast is clear. The green days are the market betting, quietly and early, that the rescue reflex born on that trading floor in 1987 is still alive, still loaded, and will fire again the moment the hawk is forced to blink. But here is the part that actually changes things, and almost nobody gets to it. So let me shift gears and be blunt with you, because I did not make this to sell you a winning streak. A few green days are not a confirmation of anything. Let me say that as plainly as I can. The financial channels are going to take this streak and package it up for you as proof. The bottom is in, the reversal is confirmed, the shakeout is officially over. And I want you to be immediately suspicious of every single person who says that to you, because it is a lie dressed up as good news. The hawk is still there. Warsh has not surrendered. The hike is still on the table. And if that fear comes roaring back, silver can round trip right back down into the mid 50s as fast as it climbed out of them. This metal is the most violent major metal there is. It overshoots wildly on the way up, and just as wildly on the way down. You just watched it do both inside a matter of days. So the streak is a clue about the reflex. It is not a promise about the price. And that is the real reason nobody on the financial channels will name what I just named for you. Because to say out loud that the market is front-running a Federal Reserve rescue is to admit the whole thing runs on it. It is to admit that the price of everything, your stocks, your bonds, your metal, is quietly propped up by an expectation that the money will always be printed to catch the fall. The people whose entire business depends on you believing the market stands on its own 2 feet cannot afford to point at the invisible hand holding it up. So they call the streak a relief rally. They call it short covering. They call it a technical bounce. They will call it anything at all except what it actually is, which is the rescue reflex breathing again. And while they are handing you those tiny little phrases, the smart money that understands the reflex is already positioned, having bought the lifeboat while you were being told the water was fine. Now, once you understand that the reflex is what moves the price around, you start to understand why some serious people argue silver is priced far below where it is eventually headed. And I want to walk you through their case honestly, because it is the value of this, but I am going to be careful to tell you exactly whose case it is. It is theirs, not mine. Here is the arithmetic a growing number of analysts put on the table. It is pure division, and you can do it yourself. Take gold, sitting a bit above 4,000. If the ratio, up in the high 60s right now, were to compress back down toward levels it has actually visited in history, silver's implied price is simply gold divided by that smaller number. Back in 1980, at the peak of that era, the ratio compressed all the way down to around $75. Run 4,000 divided by 75, and you land in the neighborhood of a couple $150. Compress it only part of the way, toward 40, and the math points to silver around $100. Those are the numbers behind the triple-digit targets you see plastered on the thumbnails. And here is the honest way to hold them. That is the number the ratio implies if it reverts, and if gold merely holds. It is a case built on real mechanics, made by real forecasters. It is not a guarantee that the ratio will revert, or that gold will hold, or that any of it arrives on a timeline you can live to see. A few days of silver leading gold is not that reversion arriving. It is a hint, not a proof. And I have to say the next part plainly, because you will run into the far edge of this. There are voices out there calling for $1,000 silver, or $50,000 gold, some clean 30-fold multiple. I am not going to insult you by pretending those come from the same place as the ratio math. They do not. Those numbers come from imagining a complete monetary reset, a dollar rebuilt from the ground up, and applying old ratios to that reimagined world. The bigger the number, the more it is assumptions stacked on assumptions. I lay out why those people argue what they argue so you understand the whole spectrum, not because anyone alive can hand you that number or a date it arrives. Which brings me back to the man on the trading floor, and to the one signal I promised you at the very top. Here is the honest truth, and I want it to land, because it is the thing I cannot say often enough. I cannot promise you a price, and I cannot promise you a date, and the second anyone does either one, you should close their video and never go back. Silver could stay cheap for longer than you think you can stand. It could fall back below where it just broke out from before any of this ever plays out. The deficit is real, the reflex is real, but in the short run the price answers to the Fed and the dollar and the mood of the paper market, not to the fundamentals. Being right and being early feel exactly the same while you are holding through the pain. This is a case for why the setup is compelling. It is not a guarantee it pays off on any timeline, and it is not investment advice. But here is the one signal, the thing the streak is actually telling you, the part they leave out. The streak is not silver saying it is safe now. The streak is the market showing you, in real time, that the rescue reflex is still the master switch under this whole complex, And that hard assets are what gets bought first when that switch even twitches. That is the insight that changes how you read everything from here on out. When you see a green streak like this one, you now know to ask the question nobody on television asks. Is this the fundamentals arriving? Or is this the reflex front-running the next flood? And when you see the next shakeout, and there will be a next shakeout, you now know it for what it is. It is the reflex temporarily overpowered by a hawk, not the story breaking. The story never broke. The story is a physical shortage 6 years deep and a rescue machine that has caught every fall since 1987. The Fed and the dollar are the weather. The shortage and the reflex are the climate. And the weather can soak you for a long, long time before the climate ever shows up on your doorstep. So here is what to actually do with all of this. And it is not advice. It is just how a calm person thinks about their own position. First, own the metal, not the promise. The whole difference between the people who came through episodes like this and the people who got wiped out was whether they owned the real thing or a leveraged paper claim on it that someone else could yank away at the worst possible moment. Second, size it so a shakeout cannot force your hand. If another flush into the mid-50s would force you to sell at the bottom to cover a bill, then your position is too big, no matter how right the case is, because being forced to sell in the valley is how right people still lose everything. And third, never sell into the shakeout. The shakeout is the machine that transfers metal from the people who panic to the people who own. Do not be the fuel. The whole point of understanding the reflex is so that the next time the price flushes and the financial channels tell you it is over, you are the one calmly holding the lifeboat while everyone else is bailing out of it. If you are on your TV, the QR code is on your screen one more time. If you are on your phone or your computer, go to jeffreedguide.com. It costs you nothing to be informed, and the honest reason to look now is this. Not fake urgency, but the plain fact that the time to think a decision like this through calmly is exactly when nothing feels urgent, which is precisely right now, in the quiet of a green streak, not on the day everyone is panicking. And for those of you who stayed with me all the way to the end, here is something just for you. If you have $100,000 or more in any retirement account, and you mention that you watched this full video, you can claim a free, one-on-one, no-obligation educational web conference. A real conversation about what you actually own versus what you only think you own, no pressure and nothing to buy. That is for the folks at that level who made it all the way here, and you are one of them. So could this video sit under some other title? No. You came to find out what silver just did that it has not done in weeks, and now you have it, all the way down to the root. It put together a streak of green days, and that streak is the rescue reflex re-engaging. The same reflex that was born on a trading floor almost 40 years ago when a brand new Fed chairman flooded a collapsing market with a single sentence and taught the market forever that the rescue always comes. And that man on the floor, the one who could not sleep, who was certain it was all coming apart, he learned the lesson that outlasted the crash. He learned that the ones who survive are not the ones who guess the bottom. They are the ones who understand the machine well enough to keep holding while everyone around them is selling in the dark. The streak may hold, and it may not, and no one can honestly tell you which. But the reflex under it is the closest thing to a sure bet this business offers, and now you can see it working. Do not just be right about the metal. Understand the machine well enough that you are still standing to see it pay.